And now I had to like wrap my head around it again, make sure that I'm coming through okay. And hopefully we won't have any internet problems. I know that everybody's been facing that, even all the things that I've been watching on TV, the investment research, tax research. It's been very spotty here and there. Even today, we were having email issues, even inter-office, and apparently Gmail has just had all kinds of issues. So I'm not sure if anybody else has encountered that, but we're going to get going here. So tonight, one other real quick thing that we'll note is Joyce is still waiting on the fabric for the masks that we're putting together for those people that have requested it. And for those people that have requested a webcam, apparently it's supposed to be here towards the end of the week. So we will get those out to you as soon as we can. And I know that those people that ordered the books last week, we got those out to you. And we do have a few. I asked Barbara before we got on here, we do have some extra books. So I'll show you how you can get a hold of that book if you want it for yourself, or if you want it to be sent to somebody else. Then as soon as we're done tonight, I'll show you how you can get a hold of one of those books. Okay, so let's get started tonight. Tonight is kind of near and dear to my heart when it comes to real estate. And one of the reasons is my grandfather was an avid real estate investor, and he had taught me a lot of what he knew about real estate. And so when I started off buying real estate, I used a lot of what he taught me how to buy it. And I owned a lot of apartment buildings, 68 units in total by the time I was 19 years old. And I originally started those by flipping those, by doing different things within the real estate market. And the three different techniques I'm going to show you tonight, I've done all three of them. Things have changed over my life and what I feel is important and what I try to focus on. And I'll tell you a little bit about that shortly. But I will tell you that real estate is a wonderful vehicle. However, many people get burned in real estate because they don't understand how to approach it. And even though I knew how to buy real estate when I was very young, it was a very big learning curve, because what my grandfather didn't teach me is all the rental properties that he owned. There's a management technique. There's certain things that you have to do as a landlord. There's certain things you have to cover yourself with from a legal standpoint. And those things he didn't teach me. He taught me how to buy them, but the other parts are equally as important. And I will tell you, when I first bought all that real estate, it was a long, hard road. A lot of days in eviction court, a lot of days in housing court to try to get things fixed. And so it was a lot to learn at that time. Thank goodness I was young and had a lot of energy. I don't know if I'd ever want to do that again, but I'm going to show you tonight some of the techniques that you can use. So let's get started. And I'm going to jump into just really what it is to actually own real estate. But before I do that, I know that I have some newcomers tonight. And I want to walk back to one of the things that I outlined back all the way back as early as March 9th. So on March 9th, we did a webinar just like tonight, and I outlined everything that you're going to see again. And so you're going to get to see what is playing out within the economy. And so far, the economic mapping is right on track. Again, last week I thought there was going to be a variation with me pushing probably 2 weeks ahead, because so many people in the country are not being compliant with staying at home to hopefully curb or level this virus. Thank goodness the numbers are actually starting to line up. So we're keeping algorithms on where these numbers are lining up. And so the mapping that I'm about to show you is right on track with where it was a month ago. So let's jump into that. And then this way you can understand how the real estate plays into the discussion tonight, when you can actually look at buying those property if you're going to buy it. Okay, let's start off by just going back to February 21st. And February 21st, and what you're seeing on your screen right now is just different lines of things that have happened. Let me bring your attention to the bottom right first, and you see birth rate in green, real estate in orange, employment in yellow, and stock market in blue, and taxes in red. And what you'll see at the beginning here in February 21st, the stock market started to drop, and it didn't drop that much, because prior to that, in early February, when we started seeing this virus kind of take over the world, most people in this country had a lot of disbelief. But what we talked about back then was the institutional selling. So the institutions are running all of these models in the background. They are running models how to play against the average investor. And today, years ago, it used to be the algorithms would be based upon, they would hire people, as an example. Large institutions would hire people, and they would sit outside the Fed, they would sit outside of government offices, and they would have people on binoculars, and they would watch people come out of the different offices, and they would try to read emotionally where they were. Sometimes they were lip reading, and sometimes it was very, very old craft. Today, what a lot of these large institutions do is they employ big data. And what they do is they will scan Twitter accounts, they will scan Facebook, they will start to see a commonality in a flow, and then they will trade against that. So we started to see that in late February, early March. And as soon as the institutions started selling, because again, they're always front running what they see is coming down the pike. And the consumer is always behind the curve. So as soon as the institutions started selling, the market started dropping like a rock. And then what happened was people started seeing it going, oh my gosh, Chicken Little, the sky is falling, the sky is falling. I need to sell, I need to sell. And the average investor just starts selling. They don't know much different. They don't understand really about, the what I call the Wizard of Oz, the little guy pulling the levers behind the curtain, and they start selling too. And so everybody now starts selling, and then you add in the lockdown, the quarantine, the country, everybody is now unemployed. They're not working any longer. Literally the country is shut down. Then that market continues to drop. Well, the real estate starts freezing. Now, if you've watched this and you track this, you'll find that real estate hasn't been dropping like a rock. Again, the first thing to drop is going to be the stock market. The real estate is always 6 to 9 months behind the curve. That's why it's important to follow this timeline so that when I outline what we're talking about tonight, you can understand why you want to wait at least another 6 to 10 months for anything to buy anything in the real estate market. So the unemployment, again, the employment is dropping. Unemployment is going up, which is the yellow line. Now what happens, the stock market continues to drop. Real estate is dropping. And then what we have is this virus leveling. And this is what we mapped out a month ago. And we said that leveling would take towards the end of May and into somewhere in the middle of June. And during that period of time, the country is still shut down. As you can see, that line is yellow. We don't foresee in any of our modeling that people are going to jump back to work. And even if they jump back to work, there's going to be things like the cruise lines, the airlines, Disney. Disney now estimated this morning that it's going to take over, not up to, but over 2 years to reestablish any kind of business in any of their parks. Not just because once they open, they're ready for business, but because they don't believe that people will feel confident. Are you going to sit on a train, getting into the park right next to somebody? You're going to stand 6 inches from somebody in line to get on a ride. I mean, if you've ever been to a Disney park, you know what it's like. It's like a cattle shuffle, right? So they believe it's going to take up to 2 years, and the success of a vaccine to make people come back to the park. Now, that won't be any different with cruise lines, with hotels, with airlines. There'll be a lot of businesses that are damaged permanently, and there will be some businesses that will just take 2 to 3 years to recover. We're talking here about that yellow line, about the general economy. Again, there's going to be certain businesses that will actually exceed where they are right now. There are the technology businesses, the video conferencing businesses, the work at home businesses. My gosh, it's the webcam business. We tried to buy 100 webcams to give out to our clients, and it's been, 3 weeks now? We keep getting back ordered delay emails. So there are things that will go off the wall, and there are things that will drop, and it will take a long time to recover. Now, we, in our modeling, believe that somewhere around the end of June, we're going to start to see the market go back. If you've seen the market drop to the 18,000 limit on the Dow and you believe now it's back, don't believe that is always going to go up from here. There could be a lot more volatility, and it's not necessarily anything to do with the actual market itself. If you watch what these hedge fund managers are doing, they're playing people's emotions. So they will buy in, they will buy in, they will buy in. And they love to take a short-term gain. So when that market goes up by 15, 20%, they might sell a couple $1 billion off the top. Now that's going to dump the market again. People will then get fearful. Oh my gosh, it's going back, and they'll sell again. This is how the institutions know how to play this game. So again, the consistency of the market going up is going to have to do with the virus itself. It's going to have to do with the reemployment of people, the opening of businesses, the economy generating, kickstarting again. Now, what will happen is that we will see this spending spree and confidence. Now, this is not the time to buy real estate because it's not over yet. We haven't gotten the institutions into the real estate game yet, and that's what you want to make sure you get in before they start playing their game. So let me go on here. So we know that the investment market's going to go up, but there's going to be volatility, and somewhere in this tune here, we're going to see a lot of up and downs in the stock market. Now, as the stock market starts to grow back, it will have more of a slow grow back as employment re-engages. However, somewhere around November, December, and the reason we're calling November, December is that there is a forbearance or there is a delay on anybody that has an FHA, Fannie Mae type of mortgage against foreclosure. So the government has instituted that. Most of the states, most of the banks are in agreement with that. So we don't see that there's going to be a lot of foreclosures. However, there may be some problems with commercial properties. There may be problems with not residential, but office buildings. There may be some things where the businesses that are employed in these or paying rents can't pay their rents, and these places are going to foreclose. It's not about kicking somebody out of their house because a commercial mortgage is not forgiven on their mortgage. They are not FHA or Fannie Mae. Again, that rental buy is not granted to everybody. So we do see right here in this area that the rental foreclosures are going to start to happen in a big way. Now, of course, what's going to happen first is because of this, normally we would see residential properties foreclose first, and then we would see commercial and retail close next. That's what's happened in almost every downturn. Now, what we're going to see in this one is a little opposite. We're going to see that residential is going to take a little bit longer, and we're going to see that retail and we're going to see that commercial is going to actually start foreclosing a lot earlier. However, don't buy into this because, a lot of times people will have that FOMO, fear of missing out. So as this comes down in value, you're going to start to see, we're starting to see it in a very small way right now, but not to the point where I feel that I would want to buy into real estate at this point. There is not enough pain in the real estate market for me to want to buy in. And the opposite is, if I had real estate right now, I would not want to be selling it unless I could get out right now. But that's doubtful. And again, there's a lot of psychology that goes into when you list a property. If you list a property for right now and it sits there for 6 months and it's at a certain price, even if you pull it off the market and then you relist it, there is a certain psychology of what you're going to negotiate with that person now sees what that listing is. It didn't used to be that way. You never used to be able to find those numbers out. Today, it's public knowledge. You can go on Zillow, Realtor.com, Redfin. You can find out when it was listed, what it was listed at, how fast they're dropping it, so you can determine how much pain that person that's selling it is in. If they keep dropping that price one after another, you know that they want to get rid of it, and you might be able to do a deal. If they just dropped it one time and it was, on a $600,000 property, they dropped to $15,000, they're not ready yet. The market is not showing that it's ready to buy that or even bid on that property yet. So now what's happening is that property value is coming down. But again, now what we're going to have is we're going to have institutions jumping into this game. As institutions, and keep in mind, it's not just institutions as far as the large companies, the public REITs. It's also large companies that institutionally own a lot of these properties. And they are in the same game as you are, and they are going to start buying. And as soon as they start buying, again, you're going to see this increase in the value of the real estate. And that's what you want to front run. You want to front run the institutions buying in. So now all of a sudden we have this area somewhere that I believe is going to happen somewhere between January and at earliest November to December, assuming that you're going to buy into retail or commercial. But if it's residential, which is what we're going to talk about tonight, I see somewhere around January to March is when we're going to see a huge drop in the residential real estate market. Now, as we continue on, we'll see that employment will continue to grow, and we're also going to see birth rates spike. And as that happens, and if we follow anything that Warren Buffett does, Warren Buffett says that the stock market will follow the birth rates because of consumption. So there's two things that happen in the market. There is short-term emotional gyrations, which is what we're seeing right now. And then there is long-term supply and demand, which is based upon consumption. And a lot of that is based upon birth rate. So, and a lot of that is also based upon taxation. So we're going to see some big problems coming down the line here with taxation, because how do we pay for this $4 to $6 trillion in addition to more money being granted? Because obviously this Paycheck Protection Program is not, it's only going to cover 30% of the businesses. You know, a lot of these businesses have a good point. Restaurants, as an example, they have to meet the qualifications within 10 weeks in order for that loan to be forgiven. And so there's a lot of companies that are not taking advantage of that PPP because they will not be able to reemploy. Otherwise, here's an example. Let's say you got a restaurant and it's sitting there and no one's going to the restaurant. Well, if they have to then reemploy those people, they're basically giving them a paycheck to sit at home versus maybe waiting it out until the ban or the quarantine is over. And now they have 10 weeks that they can afford to pay the employees when the employees can actually come back to work. So, and the problem is that the current allocation of $359 billion is only going to cover 30% of the small businesses, which is qualified as under 500 employees. So we're also going to see this delay in a lot of these businesses being reestablished. And some of them, because of the types of businesses that they are, they just will not recover. But that, again, that will transition into other types of businesses, but it will still increase the actual taxes. Now, whether that hits exactly in January, I might push this head a little bit further, because now what we're seeing is this PPP with that 10-week might push it into about March to February or March to April of next year with the tax increase. Now, during the time that you see outlined, we're going to see some massive volatility in the market. And don't think that there's anything behind this other than short-term emotions, short-term institutional trading. So going back to real estate, which is tonight's discussion, where do I think that the real sweet spot is? Again, you want to get to this before the institutions get to this. They have much better data than you and I will ever have. They literally can pinpoint a specific area, a specific drop, a specific rent cap ratio, which we're going to talk about in a minute. So you can't say you're going to buy right when they're buying. It's like Warren Buffett. Everybody says, well, I want to wait until Warren Buffett. You don't know when Warren Buffett's going to buy. He buys, and then you find out about 3 weeks or 4 weeks after he does, which the price is already going up. So you can't do this. You can't use that same psychology or same strategy in real estate. So what I'm looking at is right here in real estate, somewhere around January to March of next year. So as I've said in previous recordings and previous broadcasts, now is the time to get ready. Now is the time to set up legal structures. Now is the time to set up asset protection. Now is the time to set up the capital that you're going to need. Now is the time to start looking and understanding how to calculate the actual rate of return and risk on a piece of real estate, which is what we're going to talk about tonight. So here we go. Let's get into the actual fun of this. So I want to start off just by going through what I think is so much misinformation out there about real estate. I mean, you know, you go to the bookstore, well, whoever goes to the bookstore anymore, right? There's a few bookstores left. Well, when we used to go to the bookstore, you'd see this whole aisle of no money down, become an overnight millionaire in real estate, and la, da, 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 da. You know, my grandfather taught me one thing. He said, there is nothing quick about real estate whatsoever. Don't buy real estate because you think you're going to make a ton of money overnight. He says, buy real estate as a part of your plan, a part of your portfolio. And he was right. He had operating businesses, he had stocks, he had investments, and then he had real estate. So it was a very small part. Well, I shouldn't say a small part. It was a 20 to 25% of his portfolio. But it's not the get rich quick scheme that we all see. We see it on late night TV, etc. So true or false? Real estate is one of the safest investments. False. Real estate has more risk than a properly structured stock and bond portfolio. Now, how can I quantify that? Risk is determined by the amount that you can lose and by the statistical chance of you losing money. So let's take a look. Please don't misunderstand. I love real estate. You just have to understand it. And you have to approach it in a very calculating method as opposed to the late night TV barkers. So if you have a repair, a single roof repair, a mold infestation, an HVAC, that can cost $10, $20, $30, $40,000. So these people that are going to real estate and they're saying to themselves, oh, I'm just going to put down 5%, and they don't have the proper plan in place, those are the kind of people that real estate blows up on them. And this is why right now we're going to see one of the biggest real estate crashes since 2008. Why? People do the same thing with stocks. Look, in the last 3 to 4 years, I've tried to sway people away from buying investment properties. Now, vacation properties is a different story. But for rental properties, for the pure cash flow itself, it was very hard when you have a cap rate that is so low, meaning that how much money am I making on the value of that property? Because property values went up so fast, they didn't even keep up with the increase in the average employment rate, right? So now how are you going to go buy something and increase the rent when the people can't afford to pay it because the incomes haven't gone up? So now it kind of pushed everybody out of the market. So in the last years, well, actually since 2013, 2014, I've told people, hey, it's impossible on residential rentals unless you're going to buy a flip, which we'll talk about in a minute, to really make money on a long-term rental. However, if you tried to do that and then all of a sudden, you had a $30,000, you put 5% down because you believed what you read in some no money down book. You didn't have to have any money to buy this rental property, and then you have a $30,000 expense, and now you can't rent it because maybe the air conditioner, the heater, whatever it is, the roof falls in. You got a big problem on your hands. So that is a big risk. Another risk: location. A perfect location today may not be a perfect location tomorrow. So, in all the days that I've invested in real estate, I've made money about 75 to 85% of the time. There have been certain properties that I've lost money on. I can tell you of one that the city came through and put an easement through, completely killed the property value, totally wiped it out. I had another property that was a beautiful property, had it listed for sale. It was a huge, huge profit. And then the neighbor decided that he wanted to put in flat 8-foot solar panels on his roof. Now, the way it worked is we had a house up here and it had a perfect view of Burbank and just wonderful views of Hollywood Hills. And this guy was down here, and all of a sudden he put in these giant solar panels that looked like some industrial park, and they came up above the roof. Killed the value, right? So location is key. You hear this before. What are the 3 keys of real estate? Location, location, location. But you can't always control that location will stay the same. You have unlimited liability with a tenant. Lawsuits stemming from fire detectors, ADA violations. That's the American Disabilities Act, housing violations, and even incorrect rental agreements, eviction notices, and communications. I'll give you an example. When we had an office in LA, we had a lot of clients that had real estate there. And there was a very popular scam. I don't know if it's still going on, but people would come into a business in their wheelchair, and they were truly disabled people, and they would ask to use the restroom. They'd go into the restroom, and they would measure the exact distance from the floor to the safety handle. Picture of it. And then what they would do is they would have a group of lawyers, and they would work something out with them, and they would go and they would sue that business owner. And typically it was just a frivolous lawsuit, 10 grand, 20 grand, 30 grand. And this was a big hindrance to those rental property owners, especially in commercial and retail and office buildings, because now they had kind of had this system down. If anybody came in, they weren't using the bathroom. They didn't want to get caught in this thing. So again, real estate has some risks in just the building itself. Then you have vacancy ratios. I talked about this in 2005, 2006. I pleaded with people back then, stop buying real estate back then. And I would get people that would come in and they would tell me, hey, Ken, listen, I have a rental property and people always need to rent. No, they don't. No, they don't. We've watched in my 35 years of doing this, I've watched in every real estate crash what happens. If you have three younger people, let's say they're in their 20s, right? And so what happens now is a major recession happens like we're going to see soon. And they don't continue to rent the same place. What they'll do is they'll cluster together and they'll say, hey, I'm going to just get out of my lease and maybe I'll lose money. Maybe I don't pay it up and I just walk away. Maybe they sue me. Maybe they just give me a bad credit rating. And then all of a sudden you get 2 to 3 groups of people. They'll all move into one apartment. They'll sleep on the couch. They'll sleep on the floor. We saw this. And it's not the first time that I've seen this. Again, I've been doing this a long time. In every recession, we see the same thing. People have to adjust and accommodate. So it could leave your rental property completely vacant. Again, that is why when is the best time to buy real estate is in about a year from now, when we're at the bottom of that market. And you might be buying something that you have to compete because there's a lot of vacancies. However, when you build that into what I'm about to show you, you're going to build in that contingency of cash flow. So vacancy ratios, many people don't use the right amount. They use too small of an amount. And then you got bad tenants. This was my first lesson. I can tell you a story. I've told these funny stories to some people. One guy, one of the first rental properties that I had, and I made the mistake of falling in love with the property. It was this 1920 beautiful Victorian house in New York. And I went in I was a financial planner at that time. I was working for a large firm. So evenings and weekends, I'd go in there, I'd demo it, I'd replace everything. And, my grandfather taught me a lot about how to do that. And so I went in and I completely redid it. And I had a tenant move in. He refused to pay the rent. So we served him with an eviction notice. He left before having to go to eviction court. However, what he did was he took a crowbar to every single wall, every single piece of porcelain. I honestly cried when I went into this property because that was my first lesson in don't ever fall in love with a property. And also don't ever put in anything expensive because it may get damaged. It is a business. And again, I was very young at the time, but I learned my lesson. So again, you could get bad tenants. They cause damage and large repair bills. So, and the worst is some of them just don't pay their rents. Then I have the Carnival Promoters. These are the people, and actually we have quite a few of them right here in Vegas. They put on seminars about asset protection, about how to buy real estate, about how to flip overnight. And I've just seen some horrible things come out of these things. And, they're typically fraudsters and they're selling something. Let me put it to you this way. In the gold rush of 1849, the people who made the most amount of money were those people that were selling the picks, the shovels, the wheelbarrows, the pans. It wasn't the people that were going out and panning for gold. So I'm telling you this because there's a lot of these people selling these real estate courses. And I've seen this in the last recession. People became day traders. They thought, hey, I'm just going to get into the market. I'll leave my job. And then they lost everything in 99, 2000. And then all of a sudden the real estate boom comes and they jump over to real estate and they pay these ungodly fees to jump into these real estate courses and pay a lot of money just to learn something that I'm going to teach you in the next 30 minutes. So again, I wouldn't believe a lot of what they're trying to sell. And then a lot of the problem is that these real estate promoters, it's unregulated. I mean, it's interesting because you could turn on any TV show right now and you could watch somebody that goes and buys a rental property and they rehab it. And they'll show you, some of the shows will show you, well, they bought it for $500,000 and they put $100,000 in and they have $600,000 in and they sold it for $700,000 for a profit of $100,000. No, they didn't. First, they're not considering selling costs. They're not considering carry costs. They're not considering the amount of time it took them to do it. Are they showing them all of the properties that they're actually doing that? They're showing you the ones that they might make some money on. And so again, if you're in the investment business, you can never do that. You have to have full disclosure. So they don't have the same kind of regulations. So don't believe everything that you see when it comes to these people promoting that they can do this with real estate. Now, the good attributes of real estate and the things that I like about real estate, there is long-term growth if it's purchased right. If it's purchased in the last 24 to 36 months, you probably overpaid for it. The time to buy real estate is, again, same time to buy stock. when the pain is the highest, everybody is uncomfortable, everybody is ill-confident. People, as a general public, they don't see the positive future. That is the time to do it. Now, we're not quite there yet again on the real estate, but we're getting close. Tax deductions on both mortgage and property taxes. Now, I just want to make clear that there are some adverse tax effects. And you have to understand that unless if you make over $150,000 a year, and this gets into a whole nother discussion about IRAs and RMDs and when you take money and when you do Roth conversions. But if you make over $150,000 a year, you can't deduct anything on a rental property. So you can accumulate the deductions going forward. And when you sell the property, you can finally take those deductions. But that isn't really the spice of the real estate. So a lot of times what we will do is we will look and say, hey, if a person has a lot of rental property deductions, but they can't take them, maybe what we should do is put that into an LLC and create what we call tiered. We have what we call a holding company, and that might hold the real estate. And then we have a management company to take certain deductions that you might not be eligible for otherwise, such as maybe cell phone, maybe health insurance, maybe office in the home, etc. Again, but the tax deductions are pretty good on real estate if you know how to work them. If it's a personal residence, you can modify it at will. And I'm talking mainly about the vacation property play that we're going to talk about. We're not talking about your personal residence. However, here's another way to look at it. It's not something that I plan on covering tonight, but if you wanted to upgrade your house that you're in now, if you're ever thinking about that, wait a year. Might be a really good time to do it and turn your primary residence into the rental property. And I didn't include that tonight, but that might be one of the methods or strategies that you use. So if a personal residence, you can modify it at will. If using the vacation play strategy, which we are going to talk about here in just a minute, you can get personal enjoyment and make memories. Now that I like. And again, as I said earlier, I was going to tell you about a couple of different strategies that I've used. That's my favorite one. Because when you get a little bit older and you don't want to chase down renters every day and you don't really want to deal with flipping a property. Again, I've done so many flips that I don't think I'd ever want to, Julie laughs. She says, should we fix this or can you fix this or should we call a handyman? And I'm like, I think I've rehabbed probably 30 homes and I don't want to pick up another hammer the rest of my life. I've had enough of it. And I would much rather say, please just call a handyman. I never want to see a hammer, a saw, a drywall spackle ever again. But that's just me. I just done so much of it. You might be a little bit different. You might still like that kind of stuff. So a rental property can offer a tax deduction while still making a positive cash flow. If you purchase it correctly, you can see money in your pocket, positive cash flow, and still pay no taxes on it because we get this wonderful thing called a depreciation expense. Now, again, this has nothing to do with your income limit. You could be making $300,000 a year. You could have a rental property that's cash flowing 20 grand a year, and that depreciation is washing off any tax on the 20 grand a year. What I was referring to on the tax deduction is you have to make less than $150,000 a year to be able to take up to $25,000 in a net income tax deduction. So here's the example. You're making 100 grand a year, and that's all combined adjusted gross income. You buy a rental property and it shows a $25,000 loss. Now, it might not show a physical loss. It might be that your rental income is breaking even with your rental expenses, but the depreciation, which is a paper loss, allows you to take a deduction. If that deduction will say up to $25,000, you could be making $100,000 and it will reduce your income by 25 grand. Now, in future broadcasts, I'm going to talk about how you can actually use IRAs to actually buy investment property. And I'm not talking about a self-directed. I do not agree with those. People get blown up in the IRS with those things. But I'm talking about distributions to pay the mortgage payments. I'm going to talk about that in a later broadcast. But for today, if you understand, you could buy a $100,000 rental property and you could positive cash flow it, but you could actually still show a net tax deduction. Again, all those numbers have to be calculated in advance. It offers different diversification asset outside of normal property investments. So if you hold stocks, bonds, hopefully you have a REIT allocation within that stock bond. But the REIT allocation, while it's invested in REITs, is also more reactive and a faster volatility than an actual piece of rental property. But again, I don't want to lead you to believe that the rental property has less risk. So now we're going to talk about the three kinds of plays. So there's the vacation play. And the vacation play is when you're buying a vacation property. Now, you might make some minor repairs. Every time I've done this, we are still going in and we're modifying it because you have to make it presentable if you're going to put it on a rental market, whether it's VRBO, whether it's Airbnb, or whatever it might be. The house that we had in LA, when we couldn't sell it because of this guy across the street that put up the solar panels, we had to do some minor rehab on the inside and the exterior. We had to add a couple juicy things to it, and then we listed it with a vacation rental property manager. And it was interesting. He had all kinds of, believe it or not, he had Vegas shows. The people that would go to LA to perform that were Vegas shows, they would rent it to them, and they were looking for some certain things in that house. So you have to look at the market. You know, if it's in Hawaii, how far is it from the beach? Does it have easy access to the beach? And if it's in, you know, a ski area, are you on the ski slopes? Are you near the ski slopes? Do you offer ski passes? You have to look at it still like a business if that is what your plan is. But again, don't look at a vacation property and go, I'm just going to buy it and there's not a single thing to do. Now, you might be able to find that with a new build, which we'll talk about in a minute. But again, the goal of the vacation play is for you to have a property that you can go have fun in and that you can enjoy. So now there may be a time where you start to actually have the property rented so often that you look at it and you say, I wonder if I should even go into that, use those weeks because people are paying so much. And that actually happened to me. So I started when I was living in New York, Buffalo, New York. So, you know, you want to talk about snow. I think it's still the number one snow capital of the United States. So, you know, in the summer, there's a joke in Buffalo. It says you have 9 months of snow and 3 months of bad snowmobiling. And that's about it. And so I started buying property in Florida under the vacation play strategy. However, it was doing so well, every one of the properties was rented with so much higher income. I started saying, I can't take a week out of my rental pool, so I'd buy another one. And I'd stay there until that one got rented up. And I don't remember how many I had, 14 or 15 properties by the time I was done, but they were all paying for themselves. And it was just a lot of fun. Again, I was a lot younger. I didn't mind going in there and repainting and doing a lot of stuff, you know, as a getaway from my practice. But that is one of the ideas with the vacation play, is that you want to spend some time at this place and you want to have the renters pay for it. Then there's the play of the long-term rental, buying a property that you plan on renting full-time to somebody else. Again, a whole different type of strategy. And then there's the flip. Let's talk about each one and what I would consider the upsides and the downsides to each one of these. Now, I have done each one of these, not just one in each area. I've done multiple plays in each area. So let's talk about risk. Well, risk in the vacation plan and the long-term rental plan. Now, again, what I'm doing is I'm comparing the risk between each of these vehicles. This risk comparison is not a risk comparison compared to a CD or money market. It's not a risk comparison compared to a stock or bond portfolio. This is purely risk as compared to each other. You have the time that it takes you, depending upon if you outsource. Now, again, you outsource, you might lose 10 to 15% of your revenues. You got to put that into the calculation I'm about to show you in a minute. So in vacation plan and long-term rental, it's pretty low to medium amount of time that's invested. The flip is something that is a business that you got to have your hands around on a daily basis. Now, the gain. Well, there's a low to medium gain, and in some vacation plans, you might not make any money on cash flow because you're using the property. You're consuming some of those rental weeks. In a long-term rental, it's pretty low to medium. You're probably looking at what you're trying to achieve is a minimum 10% rate of return that accommodates for the additional risk, which I'll get into in just a minute. And then you have the flip. Well, if I'm going to do a flip today, I better be making 30 to 50% on my cash invested. Otherwise, it's not worth the time. For me now, it's not worth the risk. I've just seen too many things within flips that it can go sideways very quickly. You know, you tear a wall out and there's black mold, forget it. You're talking $10,000 to $20,000, $30,000 just to get that house fixed up. So again, the flip is very risky. Capital needed outlay. So low to medium on the vacation plan, low to medium on the long-term rental. The flip, you better have a lot of cash, especially for those emergencies. The tax benefits, high on vacation plans, high on long-term rentals, low on the flips. The reason is if you start flipping properties, you are going to be considered an investor, and you are not going to qualify to this. Calculate your maximum buy. All right, so if you're using the vacation play or the long-term rental play, let me just back up to see. Let me just double check here. Daniel, can you give me a hand raise? Did we go through all of these items? Perfect. Just wanted to see where we left off. Okay, so we're going to calculate our maximum buy. What is our maximum buy? It is going to be the maximum amount that you can afford for risk, the amount of capital you need, and what we call the cash flow tolerance test. This is in case you have vacancies. This is in case you don't have income coming in from these rental properties, or if it's on the flip, it's in case you have a delay in getting that property sold. And these are things that are real risks. So if we're using the vacation play or the long-term rental play, we're going to use the investment calculation. But if we're using the flip method, we're going to use the new business. This is no different than if somebody wants to come to us and start a new business. We are going to create a business plan. We are going to figure out all the risks, the capital, the contingencies. That's the same as what you're going to do with a flip. Now, if you're a client of ours, because I see there's a bunch of people that are on today that are not clients, so welcome. Hope you're enjoying this and getting some really good information. If you're a client of ours, we do these calculations for you. You have to do the searching. We can't go find the property for you. But once you find a property, we can do the calculations for you. We use eMoney because eMoney is going to figure out your exact tax calculations, your exact income tolerance, your exact capital outlay. It will calculate all of those options so that we can figure them out. Now, I'm going to show you some options, if you're not a client of ours, where you can just find some online quick and dirty kind of calculators. And even if you're just researching some rental properties, I'll show you some real quick calculators that you can do just to kind of eliminate some of those waste of time properties, okay? So how does the long-term rental method and the vacation method actually work? So we're going to figure out three things. One is maximum down payment, cash reserves needed, and negative cash flow tolerance. Again, negative cash flow tolerance is something that we're calculating within eMoney. It is different than the actual real estate calculation. We want to make sure that if we're going to buy a piece of rental property and something goes wrong, you can afford the negative cash flow outlay, okay? So if we're using the flip method, there's a few different items that we're going to calculate. We're going to calculate initial capital needed, reserve capital needed, repair and modification budget and overruns. What is that? Well, that's the black mold that you find behind the drywall. That is the galvanized pipe from the 1920s, or the lead pipe from 1920s, or the all famous asbestos. It was interesting. You talk about getting sued. So I had a rental property. Oddly enough, I remember the actual address because it was just such a stick in my side. 311 Bird Street in Buffalo, New York. Anyway, so I had sold the property, bought the property, had it for about 3 years, flipped it. And probably 15 years later, I was served with a lawsuit from like the 1960s. And they must have had 100 people listed on this lawsuit that owned the property because of lead paint. And, I got out of it and I didn't have to pay anything, but just goes to show you, you could have these contingencies. You find out there was asbestos, there was lead paint. Now you're going to have a completely different remodel situation. Initial cost of buying and selling costs. Don't forget, you got to remember when you're buying property, unless you're going to go get a real estate license, which, I actually went and did that when I was 19, just because I looked at it and said, buying these things and selling these things, at least I can save half of what that commission is that the realtors get. So I went and got a real estate license. If you're not willing to do that, you got to calculate in what that cost is. And please do not take the opinion, I'll just sell it myself. Listen, I have to give real benefits to those realtors. Some of them are unbelievable marketers. I've had some realtors that would put on dinner parties and they would do all kinds of crazy stuff to sell a property. And if you find the right realtor, they've got to calculate that cost. Do it yourself to save 3 to 5% in commission. You got to just calculate the cost of doing business. So you got the selling costs. And then you have the delay costs and cash flow tolerances. I had one property that was a complete teardown. And what happened is another real estate investor came onto my property during my teardown. And I had a crew of 9 people. He came in and offered a huge sum to these people to leave my property and go work on his, because they knew that I had trained them, I had taught them how to do it, and I lost about 5 of my workers at that time, and I had to rebuild my crew in order to get them to rehab. So that's just one extreme, but there's other delays. There could be, government shutdowns. No, that would never happen. The economy could shut down. I mean, you could have inspectors that take a long time to get out there. You could have a plumber that just doesn't show up on the job. So there are things that are inevitable in a flip. Again, do not let these TV shows believe that it is so easy. It is not. It is a business. So again, you have delay costs and cash flow tolerances. All right, so let's get into how I do it. I'm going to kind of show you the methodology that I use, not only to find the properties, but to kind of outline where I'm going to start looking. So what I will do is I will take a map, and here we have a map of Las Vegas. And I will take a look, and I think I pulled this one off. Yeah, this one's off of a Redfin. And you can see here on Redfin that what I did was I just drew growth patterns. So where are they building right now? Where are the new houses going right now? And the strategy that I've always used I shouldn't say that. The strategy I originally used is I would go in and find flips, and those were generally in the older parts of town where things got run down. But when I started calculating my returns based upon what I call the forward-looking buy, I would start mapping where the population was moving to. Where were they building? And then I would buy ahead of that. I would buy outside of that. I didn't want to buy right where it was. I would buy ahead of that, whether it was a new build, whether it was something that was older that I could flip, and I wanted to buy ahead of that growth. So where are we growing right now? Well, we can see here we're growing into these growth areas. Again, this is not a vacation play strategy. This might work with a long-term rental play. This might work with a flip play. If you're going to do the vacation, it's going to be around what are those activities that are going to make it the most rentable. And again, you're going to just outline that map in the same methodology. So the considerations, what is the distance and on-site questions? Property management, are you going to self-manage and outsource manage or outsource manage it? What are the repairs? Are you going to self-repair or outsource repairs? This is one of the hardest things to do because it is really hard to find a good handyman or a good repair person or a good crew. That is I would believe that is the number one thing that held me back. Once I got a good crew and I got good people, the repairs was easy. I could depend on. I can tell you one example of this. I did have a rental property in Florida. I had a property management company that was terrible. They went and bought a door, and they charged me $800 for a front door. When I looked, the door was $300. They upcharged me. Then I had another rental property company that they charged me to lay carpeting. But what they did was they hired somebody that was so subpar, and as you probably know, when you lay carpeting, if there's a seam, generally what they'll do is they'll take carpet tape, they'll seam the carpet together, and then what they'll do is they'll heat it so it seams together. Well, this is, again, I have a storybook full of real estate stories. What their person did is, because they forgot the heater, they took a lighter and they tried to seam the carpet with a lighter. And every 3 or 4 inches, you see these burn marks. So again, it's true story, believe it or not. It's very important that you find somebody that is a good person to help you with the repairs, unless you're the person that's just going to go out and do them yourself. And the growth of the city and what you're buying. Compare age of home and area and what it may cost to upgrade or repair. Many times the cost of a new build in a recession is close to the cost of a 10-year-old home without the repair and replacement cost. So we know that an HVAC system is 10 to 15 years. A roof, you're lucky if it's 15 to 20 years. We know that plumbing could be 20 to 30 years. Electrical systems, 20 to 30. But again, a lot of times you can actually, especially in a recession, you can buy a brand new house. We did that in Vegas. When the top of that was about 11, 12, we bought a house in Vegas in 2013. And it was right when the market was starting to come back up again in Vegas. It was still desolate here. I mean, downtown Summerlin is an area right off the 215, and it's a huge shopping area now. But at the time, it was rusted out girders and pit. And so we bought a house in 2013. And when I started doing these numbers, it was cheaper for me to buy a brand new house, have it built, than it was to buy an existing house and put the repairs. Even though you can get that existing house up to repairs, you still have older structure, you still have older roof, HVAC, etc. And sometimes some of the older finishings you have to still repair. So again, that's a disadvantage. I think we're going to see a lot more of that in the next 10 months to 12 months. And what you want to do is create a hotspot of areas and save your search. So what you want to do is, again, this is just my preference. I use Zillow, I use Realtor.com, and I also use Redfin. Why do I use all three? Interesting that all three do not always show the same properties. So I'm on a hit list where I say, hey, this is my search criteria. These are the number of bedrooms. This is the price range. And if I put it into a zone, like you saw in that picture before where I've outlined that zone, it's going to tell me when those properties come up in that zone. So now I created a search list and I'm going to save it. Now, if you're using the flip method, I would give you one additional notification. There are foreclosure and tax lien sites that you can sign up for. Again, find your area and generally the county clerk. And there are some private sites that you can sign up for. Foreclosures get listed. Redfin does it. I believe Zillow does it. And also tax liens. So that's another way to purchase a property. I don't do it because there's too much risk in that person taking that property back, which means a lot of times I can't do a lot of the rehab and things that we would have normally done. So I've never done a tax lien. We'll never do a tax lien, but some people my aversion to risk. So the first thing we're going to do is we're going to calculate the ROI on each property. So we're going to figure out what are the outer edge selling prices to rent ratios. When I talk about outer edge, I'm talking about that map I showed you where we're mapping where the population is moving to, not where it was, not where it is. Where is it moving to? Because again, just from what I've done in the past, that's where I can generally get a much better price on the house and understanding that I'm going to have to ladder in that rent over a period of time. But that's generally what I have done in the past. Not to say that you can't buy in an existing area. I'm just showing you my pattern of what I've done. So you're going to go to the outer edge. You're going to figure out the prices to rent ratios. Here's what you're going to do. The first calculation is you're going to figure out the annual rent per square foot. So here's just an example, square footage method. I'm going to take 3,000 square foot house. I'm going to divide it by 2,000 a month, $24,000 a year. I'm going to come up with a factor of 8. I'm going to then take a valuation method of the value of the property divided by the actual rent. I'm going to get $25 a square foot per year. The third calculation I'm going to use is I'm going to calculate the cap rate. That is the value divided by net operating income. If I have $24,000 a year in gross rent, after I account for expenses and vacancy ratios, my net operating income might be $18,000. So now I have a cap rate of 3%. Add the cap rate plus the appreciation. So again, in my initial calculations, I'm going to assume an assumed calculation. If I assume 5% in my long-term appreciation, and I have a cap rate of 3, I've got a total of 8% potential rate of return. So again, I'm going to determine what that potential rate of return is. The first 3 methods that I gave, or the first 3 methods, which is the square footage method, the value method, and the cap rate method. These are methods that I'm going to utilize to compare properties. So when I compare property 1, property 2, and property 3, I'm going to use my square footage method, my value method, and then I'm going to calculate the cap rate. Again, you have to have a little bit of a talent to walk in there and say, if I'm a renter and I have 5 bedrooms, but I have 2 bathrooms, am I going to want that property? So you got to look at some of just the basic logistics. And on a side note, I have just been bewildered by some of the architecture. I mean, some of the houses that I have seen, and we still actively look for properties. I don't know where these architects got their degree. I mean, who builds some of these things? They're not really usable. Now, if I have a 5-bedroom with a 3.5 bath, that might make sense. We've seen 5 bedrooms with 2 baths. So you got to look at, is it rentable? What is my market for that property? So again, I'm going to develop the cap rate. I'm going to actually show you how you do that in just a second. If you have a properly designed stock bond portfolio, you're still going to have volatility risk. We've seen that just in the last month. But if you have a rental property, here's what you got to look at. You're going to have volatility risk. Again, the volatility risk is not denoted on a day-to-day, hour-to-hour, minute-to-minute, second-to-second basis like the stock market. But you're going to have volatility risk. It will just ebb and flow in 1 to 3 year periods, okay? So you're going to have volatility risk. You're going to have repair risk. You're going to have location risk. You're going to have easement risk. You're going to have lawsuit risk. You're going to have tenant risk. And you're going to have vacancy risk. So again, your risks, in my opinion, on a rental property are much, much higher than a stock bond portfolio. I am not telling you that you throw it all into stocks and bonds. I'm telling you that you have a diversified portfolio. But when people come to me and they say, well, I want to buy real estate because it's less risky than stock or bond, I will argue that till the cows come home. And I have authority in that because I've done so many properties. You can't tell me that. You can get sued for everything that you own in a rental property. If your stocks go down, no one can sue you for your house, your car, and all your assets. But you mess up on a rental property, you don't have a properly installed fire alarm or a fire detector, and somebody gets hurt, they can take you for everything that you have. So again, there's more risk, and you want to be compensated for that risk. That is the whole idea. Look, I tell this story sometimes. Here's the way to understand. Let's say that you were looking for a job and you went to a construction site. And on that construction site, they're building a 30-story office building, apartment building. I don't care. It's a building. And the foreman comes out and says, so you're looking for a job, huh? He said, yeah, I'm looking for anything at this point. I just need a job. And he said, well, I got 2 jobs available for you. Here's the first job. You're going to go 30 stories up on a single elevator. We'll give you some safety equipment like, a hard hat. And you're going to walk what we call high iron walkers. You might have seen this from like when the Empire State Building was built, and you've got these 3 or 4 construction workers, and they're sitting about 100 stories up with no protection, and they literally walk across this little beam every day. So you get a job, and here's what they'll tell you. We're going to give you a job, high iron work, walking. That's where you're up at the top. And you say, well, okay, what does it pay? Well, it pays $30,000 a year. Okay, well, what's the other job? Well, you can be here on the ground floor, and all you're going to do is you're going to fill up a wheelbarrow, and you're going to take it from the sand pit into the cement mixer. And what does that pay? Well, that pays $30,000 a year. Well, wait a minute. Why should I risk my life for 30 grand when I can be on the ground for the same 30 grand? You're going to pay me, I want 60 grand to go up on top of there. So what I'm saying is you have to have a relative reward for the amount of risk that you're taking. That reward should be much greater. So as an example, if you have a stock bond portfolio, and let's say that you have an allocation that has a target rate of return of 5 to 6%, on a scale from 0 to 10, you might only have a risk factor of 5 or 6, right? However, if I have a piece of rental property, because of the inherent risks, I might be able to make 10, 15%, but I have a high risk. So you have to make sure that you're making that rate of return before you take on that actual risk. So the ways to figure that out is you have to have here's the methodologies, the calculations that I use. You have total return on investment. Total return on investment includes the amount of tax savings that you get. It includes the appreciation. It includes figuring out the recapture on the depreciation and the capital gains on the growth. And it also figures out the actual amount of cash flow that you might get from that rental property. So you have total return on investment. You have cash on cash return. What does that mean? Well, we want to figure out when we buy a rental property, what is that sweet spot of the down payment? Again, we don't want to upset the other part of our diversified portfolio, but we want to hit that sweet spot of the down payment. So if somebody comes to me and says, I'm going to give you a 3% mortgage for 30 years, I'm going to put down as little as I possibly can. If they tell me that here's a rental property, I'm going to flip this thing, I figure out I could probably make $100,000 on this thing in 90 days, but I need to come up with $100,000. So I have 100% of rate of return on my money, right? So I have 100% rate of return on my money in potentially 90 days, but I have a high risk. Well, if that person said, we'll give you a mortgage and that mortgage will be 8%. Okay, well, I'll take 8% because I'm only going to compute that for 90 days because I'm going to flip it. So again, each calculation is different. I'm going to show you where you can get some calculators to figure this out, but you have cash and cash return. Then you have time investment. You have to figure out how long is it going to take me to turn that money over. Think of a grocery store. The grocery store is all about turnover. If you take a box of cereal and you can sell 10 boxes of that cereal and replace it every single day, your turnover is much greater than if you could only sell one. Even if you have a higher profit, if you have a 30% profit on one box of cereal versus 10 with a 300% turnover, the grocery store is going to choose the product that has the higher turnover. Why? Safety's in the numbers, right? So again, it's the time investment. Then you compute what the total risk is and what the other benefits are, including, hey, if I'm doing the vacation play, I'm going to figure out how much am I going to be able to use that property? What would I pay if I had to rent, right? So if I go to a ski vacation and they tell me you're going to have to pay $500 a night, not that I would ever spend that, but I'm using this as an example, but $500 a night, you're all laughing because you know how cheap I am. I might use my points on my credit card, but let's just use an example. They're going to say $500 a night for a ski vacation. I'm going to compute what, if I'm going to use that number of days, would it cost me to do that on my own versus if maybe I just wanted my own lockout closet. Maybe I wanted to have my kids and my family meet me there for 4 weeks out of the year. And to me, there's a certain point in time you get to in your life and there's nothing else other than memories. Memories are priceless. So you want to compute that into the calculation because that's an important part of the decision. So what are the other benefits? Vacation play. I'm not going to accept on any rental property. I will never accept a rate of return. I'm still going to compute my risk, but there's no way I'm going to take any kind of rental play, any kind of real estate play at less than a 10% rate of return. So 10% is acceptable minimum. Versus what is my other investment? If I have a total return expected on a stock bond portfolio of 6 to 7% and a risk of 5 to 7 and zero amount of time investment, because remember, you got to compute the amount of time it's going to take you to do this. There is a cost for that. I don't care if you're retired or not. There's other things you'd probably rather do than get on the phone and argue with a renter. Okay, so understand what that rent versus return is going to be. So let's go to, let me back up a little bit. I'm going to show you this calculator real quick. And I know we're running a little bit over because of the snafu of the internet, but bear with me 1 second here and I'm going to find this. And I'll tell you what I'm going to do. I'll just bring it right in here to the screen and hopefully you can see this. There's a lot of these calculators out there. I'm not telling you that this is the right one, but there's a bunch of different calculators that you can use. Let's see, here's an investment property calculator. And all they're going to do is they're going to line up the numbers for you. So let's say that I've got a $600,000 property, and I'm going to go into this thing because I've done my calculations. I'm only going to put 10% down on that property. You always have to compute the land value because the land value is not a tax deductible or depreciable expense. So if I have a $600,000 property, I might look and say, hey, the land value is $100,000. The personal property you're really only going to use if you're going to buy a property that has furnishings such as a vacation play property. The building value is basically going to be the difference. So I'm going to have $500,000. And let's say that I have $40,000 in annual rent, but I have to compute that I'm going to have $5,000 in vacancy, right? So you have to compute that vacancy ratio. Now, since I don't have, in this particular calculator, since I don't have anything entered in personal property, I'm going to leave 20% because it's not going to compute anything. And it will figure out because it's private rent or it's residential rental. So the depreciation factor is 3.64% per year. So the building depreciation that I'm going to be able to take a tax write-off on is going to be $18,000. Now I'm going to figure out how much am I going to finance. Well, here, if I go back, I have $600,000. I have cash invested of $60,000. And so I have $540,000. And let's say I can get that rental property interest rate at 3.25%. And again, in low interest rate environments, I'm going to want to stretch that out as long as I possibly can. If they give me 40 years, I'll take 40 years because it's all about holding or leveraging those dollars. In this particular calculator, I'll just hit calculate. And let's see, what am I missing here? Calculate. And, oh, here, annual expenses. Okay, so let's say I have $5,000 a year in annual expenses. Utilities, $1,200 in insurance. Let's say I'm going to put in here a percentage. So I'm going to put in, let's say $5,000 a year in annual repairs and maintenance. Let's say I have $1,200 for advertising. Let's say $1,200 if I put it inside of an LLC and I have a tax return done. Let's say $500 in miscellaneous or supplies, and maybe just an excess safety valve of say $1,200 for miscellaneous. So my total operating expenses are $17,800, which equates to 50.86% operating expense ratio. Now, again, that's pretty high. And a lot of times people will find actually a better rate of return in a business. Now, see what happens if I increase this rental income. Let me just go back and find, where is that rental income? Here we go, annual rent. Let's say that I rehab it a little bit. I can get $60,000. Well, now what's going to happen is that will change my operating expenses. But let's just for now, let's put this at $40,000. And let me go back here. $40,000 is my gross rent. I have total operating expenses of $17,800. 50% operating expense ratio. Now, watch what happens. If I'm in a high tax bracket, this thing's really going to benefit me quite a bit. I'm going to use just the federal bracket. If I'm sitting in a high taxed communist socialistic state like California, you might be paying 50-60% in tax. If I assume a 50% rate appreciation rate, this will calculate all my numbers for me. So here we go. When I go back in, I can now figure out my net operating expenses, my cash flow before tax, my taxable income. This is what I'm going to take as the tax write-off, right? Here's my cash flow after tax. So in this particular case, if I'm doing a vacation play, it's going to cost me $4,000 per year. Now look, if I'm going to stay in this property for 4 weeks with family and it might cost 20 grand to rent a property, that's a good deal. I'm going to save $15,000. So here's what the cap rate is. The cap rate is only 2.8%. If I add that to the appreciation rate of 5, I've got a 7.87% rate of return. My cash on cash is negative 18. So now if I want to figure out what is the amount of rental income that I got to get this thing up to so that I can get my 10% rate of return, I'm going to play with these numbers. So now I'm at 6% cap rate. If I add the appreciation, now I'm at 11.2%. So the question is, if I put some repairs into this property, can I get that rental income up to $60,000 per year? You have to just do the research, and most of that is available right on Zillow. You can look up what the average and say, hey, why are they only getting this certain amount of rental income? What do I have to do to increase the rent? So these little tools, and you can see this right up here. Again, you could just type in, rental property investment calculators, and there's a million of them online. They're all free. I've just built my own spreadsheet to do this, but I just wanted to show you that there's plenty of online calculators. Now, again, if you're a client of ours, what you want to do is identify where the property is first, identify what kind of play you want, long-term rental, flip, or vacation play. Start finding the properties, go into these free calculators, and figure out what your ROI is first. Once you've identified 1 or 2 properties, then you're going to get a hold of your financial planner, and then they will run this calculation through your e-money account to make sure that it's going to work for you, okay? All right, so let me jump back. Hopefully that helps you out, and we're going to get back into where we can go from here. Okay, I'm going to open this up to questions in just a minute. You can see on your screen here, if you wanted a copy of the book, my book that I wrote back in 2016. We have some copies at the office. We're willing to send those out. I know a lot of people are sitting home reading books, educating themselves. I've got a lot of stuff in rental properties in here and asset allocation, how to tax efficiently develop an income. We'll send that book to you free. No shipping, no cost. We'll get it out to you. We have some extra holdovers at the office from the publisher. So just give our office a call, 844-702-1040, or send an email over to admin@hhtba.net. We'll get a book out to you as long as supplies last. And then last, again, we've changed up the schedule just a little bit. We're doing the live webinar at night on 4 o'clock. You can go to our website. You can actually find that webinar schedule. And let me show you how to do that real quick before we wrap it up. Just go to hhrdm.com. You're going to pull our website up, go to events, and you're going to see a whole brand new broadcast schedule right here. You can click to register on the webinar, or what you can do the next morning is you can join it. It's going to be the same thing that you see at night. We're going to replay this in the morning for those of you that can't join on the live webinar. There won't be questions available because it will be unattended. It'll just be a live replay. So if you have family, you have friends, you have people that you want to watch this, you can send them an email, send them an invite. They can join in. They can subscribe to the YouTube channel. Okay, the other thing is you can go right to the live broadcast from here. So right from the web page, if you hit live broadcast, it's currently offline, but tomorrow morning at 9 o'clock, it will be playing. And you can watch the live broadcast again, watch the replay. Okay, with that in mind, because we're running over, I'm going to jump in with questions. Again, I can't answer any specific questions that people have on a specific property. If you have a general question about real estate, the market trending, the difference between the vacation play and, say, the flip play, go ahead and ask that. We are running out of time. I'll tell you what, we are 20 minutes over. So here's what I'm going to do. I see some questions coming in right now. I'm going to answer those by email just so we can wrap it up. Thank you for joining. Thanks for bearing with us through the little snafu we had there on the internet. And with that in mind, I am going to bid you a great night. Please stay safe. Please stay in your home. The quick. Hopefully tonight this has been of some help to you. And again, just get yourself ready for the soon to be wonderful buying market of real estate. With that, have a great night.